Welcome to today's event, ESOPs, the Exit Strategy for Legacy Preservation. Before we get started, let's do a quick sound check to make sure everyone in the audience can hear us. I would appreciate your help with this, so please go ahead and type yes into the GoToWebinar questions pane if you can hear me, and feel free to let us know where you are joining from. Thank you, and we will begin shortly. Excellent. Well, I'm seeing your responses come through, and it looks like we have folks from Washington, D.C., Phoenix, Minnesota, New York City, and Texas. So we have folks from all over the country, and we're really glad that you decided to take some time to be with us today. Our program today is ESOPs, the Exit Strategy for Legacy Preservation, with Nick Adamy and Lindsay Gibbons of Adamy Valuation. My name is Liz Brigson, and I will be your host today. At Encorsa, our goal is to bring you a variety of content from some of the top presenters in the industry to meet your CPE and educational needs. We have just a few housekeeping items to run through today. So first, CPE credit. To qualify for CPE credit, you must remain logged in and answer at least 3 out of the 4 polling questions. If you do qualify for CPE credit, you will be able to log into your Encorsa dashboard and download your CPE certificate 1 hour after the conclusion of today's program. If you have any questions about CPE, you can contact us at support@encorsa.com. We seek to make each event as interactive as possible, so if you have any questions, feel free to enter them in the questions box, and we will do our best to answer your questions throughout our time together. Also, Nick and Lindsay will be monitoring the questions box, and if we're not able to answer your questions today, we'll actually gather your questions and we'll send a follow-up email to make sure that everyone has a chance to hear the responses. At the end of the time together, you'll have the option to take the course survey when you close the GoToWebinar panel, and we do read your feedback to continuously improve your experience. You can access the slides for today's presentation from your Encorsa dashboard and also by navigating to the handouts pane within the GoToWebinar panel. Just like Encorsa, Adamy Valuation is based in Grand Rapids, Michigan, and serves clients across the country. I have known Nick and Lindsay for years, and today it is a privilege to introduce Nick and Lindsay to you. Nick is Managing Director of Adamy Valuation. Nick has a background as an industrial engineer with an MBA from Michigan that led him to Duff & Phelps before returning to Michigan to become a second-generation leader with Adamy Valuation. Nick is actively involved in the ESOP community and has an extensive experience advising clients of all sizes with ESOPs, as well as other business matters such as estate and gifting, M&A, and litigation. Nick is a humble leader with a deep wealth of knowledge. Lindsay is a manager with Adamy Valuation with a strong background in business valuation across many applications, including ESOPs, succession planning, M&A, and financial reporting. Lindsay recently completed the requirements to become an accredited senior appraiser. That's the ASA designation that you can see. And this is commonly recognized as one of the preeminent designations in business valuation. Lindsay is a person of high integrity, and she is wonderful to work with. Nick and Lindsay have a great program planned for us today, so let's get started. Nick and Lindsay, it's great to have you with us.
Well, thanks a lot, Liz. You managed to make us sound pretty good. This is Nick Adamy here.
And I'm Lindsay Gibbons.
Can you hear us okay?
I can.
Fantastic. Well, let's start flipping through the slides, and we'll talk about our goal today. So we don't really want to try to make everyone an ESOP expert today, but our goal is really to give you guys, and I apologize, I'm from Michigan, so I'm going to say you guys as the trusted advisors, we want to give you the tools to be able to talk with your clients and serve them well when they come to you to talk about exit options. Inevitably, you're the first line, the first people that they're going to come to as that trusted advisor. And we want to make you comfortable talking about ESOPs and being able to identify whether or not this is an option for certain of your clients to explore. So with that, a little bit more specifically, in particular, we want you to walk away with a basic understanding of how ESOPs work, how they fit into overall succession planning for your clients and their business owners. we want to help you understand generally what does the process look like to implement an ESOP. Of course, we've got CPAs on the line here, so we've got to cover the tax benefits. That'll be a little bit of a fun technical discussion. And finally, and frankly, most importantly, we want to help you understand what are the characteristics that make for a good ESOP candidate. I think that takes us to our first polling question.
It does. So we will launch that first polling question right now. This is the first of 4 polling questions. And the polling question is now out for the audience to respond to. You can answer it within that polling question pane. And this just gives us a chance to learn a little bit more about who's with us today and your background with employee stock ownership plans, or ESOPs. So we'll leave this open to make sure you can get your CPE credit. And then feel free to ask questions, and as we move forward on future polling questions, we'll be able to use this time to answer your questions. So very good. As the results are coming in, I'm seeing that we have a very good number of people with us who are somewhat familiar, and also over 40% who say this concept is mostly new to me. So we'll go ahead, we'll close that polling question down. We'll share the results so that you can all see who's with us. And Nick and Lindsay, can you see that?
Yeah.
Yes, we can. Great, great. So we'll go ahead, and now that we have some knowledge of our audience, we'll continue on.
So it looks like right around 40% of you guys are not as familiar with ESOP. So this is the perfect introductory slide. What is an ESOP? An ESOP is an employee stock ownership plan. Similar to a 401k, it's a defined contribution plan protected under ERISA. And under a defined contribution plan, each employee contributes money to their individual accounts. And in the case of an ESOP, this money is used to buy shares in the company. Now, similar to any retirement plan, the goal is for the value of each participant's account to increase over time. And then at the time of retirement, the participant receives distributions from their account. Now, a participant's account balance is dependent on 2 factors: the number of shares they have in their account and the price of the company's stock. ESOPs are valued at least once a year, and through this process, a stock price is determined. So at the time of retirement, the number of shares is simply multiplied by the most recent stock price. Now, in implementing an ESOP, debt is often used to finance the transaction. And it's not uncommon for this debt to be in the form of bank debt or seller financing. And later on in this presentation, we're going to go into more detail as to how you can set up this kind of transaction. It should also be noted that there are significant tax benefits associated with ESOPs. These benefits exist both for the selling shareholder and the company, and we'll discuss these in greater detail. So why choose an ESOP? There are quite a few reasons as to why an ESOP might be the best option for one of your clients when they're considering transferring ownership. One benefit of an ESOP is access to liquidity. The current owner can achieve liquidity without leaving the company or disrupting the management structure. This allows the company's legacy to continue on. Another factor is that no layoffs result following an ESOP transaction. And this is very much tied to the first point, but the overall structure of the company doesn't have to change, so layoffs typically don't take place. The company is able to remain independent. It does not become subjective to the benchmarks of a private equity firm or strategic buyer, but rather the company can continue to operate under its own goals and objectives. The business name and culture remain intact. And from our experience, we've seen that culture becomes more deeply rooted and more of a positive benefit following an ESOP transaction. And this is largely driven by the fact that employees not only have a sense of ownership in the work that they're doing, but they have actual ownership in the company. Again, there are significant tax benefits, and an ESOP also allows for flexibility in how you want to structure the company.
So I'm going to talk a little bit about some of the rules that apply. Obviously, there's a lot of rules, and I should point out too, please ask questions. We may pause to answer some of these questions verbally, and at the very least, if we don't get a chance to answer the question for everybody, like Liz mentioned, she's going to aggregate the questions, and we'll have an opportunity to share the questions and answers with the entire group over email afterwards. So like any government program, there's plenty of rules. And if you're familiar with 401ks, then you're probably about 80% of the way there. ESOPs are subject to the same ERISA rules as 401ks, as defined benefit plans, but there's some nuances that are specific to the ESOP. In particular, the ESOP can't pay any more than fair market value for the stock that it buys, and it can't sell for any less than fair market value. In general, all the terms of an ESOP transaction have to be at arm's length. It's important to understand that, again, like a 401k, an ESOP can't discriminate. So this is not a management incentive plan. We've had owners come to us and say, I'd like to reward some key management, and I'm thinking about an ESOP. Well, the ESOP isn't exactly the right way to do that. The ESOP is a broad-based, qualified retirement plan. It's regulated by the Department of Labor as the primary regulator, and the IRS then also has kind of a secondary role, in particular when it comes to the transaction and some of the tax consequences. Speaking of the transaction, let's talk a little bit about how ESOPs are done. And that brings us to our next slide. There's a lot of different ways to use an ESOP, a lot of different ways to put an ESOP in place. We want to give you guys a little bit of a flavor of some of the typical ways that ESOPs are put into place. And while you can put an ESOP in pretty simply and simply contribute stock to the plan going forward, it's more common to do a transaction. And this looks an awful lot like a regular mergers and acquisitions deal. I think it's particularly helpful to think about an ESOP deal like any other M&A deal. You've got the buyer and you've got the seller, and each side has their own team of advisors. For an ESOP, the buyer is a trustee, and the trustee has a fiduciary obligation to the ESOP to look out for the best interests of the participants. And that trustee, in their role as buyer, will put together a team around them of a financial advisor and legal counsel. Often the sellers do the same thing. They've got their financial advisor and their legal counsel, just like a seller of a company would hire an investment banker and an attorney. You can sell any amount of stock. There's some kind of magic numbers. 30% will help trigger some tax benefits that might be attractive to some people. We'll talk about that later. And bank debt, along with seller financing, is often used in order to do a larger transaction. Rather than kind of pay as you go, you can use bank debt to achieve some liquidity and do more of a lump sum ESOP transaction. Frequently, we're seeing ESOP transactions that are done 100% right out of the gate. I think that takes us to our second polling question. And after that, Lindsay is going to walk you through a little bit more of the details of how an ESOP is put in place.
Very good. So that second polling question is live, and the question is, how frequently do you discuss exit planning with your clients? So we're curious to know if this is something that's part of your ongoing conversations periodically, or if it really depends on the client need, and perhaps it's something that you're not currently doing, but it's something you would like to consider for the future. So while we leave that polling question open, Nick and Lindsay, I did have a question for you. Thinking about the transaction that you just talked about high level, I think you'll get into the details a little more. How is the business owner involved?
Good question. So the business owner often takes a little bit of a back seat. Just like, again, if you hire an investment banker, you're really hiring that investment banker to represent the company and the business owner and go out and market the company and negotiate with potential buyers. In an ESOP deal, usually the seller will have their own investment professional, investment banker or financial advisor who plays the same role. The difference is they're negotiating with the buyer, the ESOP trustee. Obviously, the ESOP trustee's financial advisor, and that's the role that we typically play, needs to learn about the company, do their due diligence. And so when we're in that role, we will typically meet with the owner along with the rest of the executive management team to learn about the business, tour the facilities, do due diligence, and kind of go through a typical process, just like a buyer would if they were negotiating with any other seller.
Very good, thank you. We'll go ahead and close the second polling question down. Thank you for your responses. And we'll take a quick look at those responses. It looks like almost 50% of our audience today has exit planning discussions with their clients based upon the need. So this is a really great tool. ESOPs are a great tool to have in your resource library as you're having those conversations with clients. So we're moving on now to steps to implement an ESOP.
As Nick mentioned when he introduced the transaction process, this process is really not that much different from a typical M&A deal. So I would expect that as we walk through these steps, a lot of you will recognize this process. Typically, this takes 3 to 6 months to complete all the steps. And the first step is to hire a sell-side advisor. Now, this individual is going to work with and for the company to help determine the transaction structure and arrange financing. The second step is to hire a trustee. The trustee will work for the ESOP on behalf of the ESOP participants to ensure that the structure and financing is fair. Now, in order to determine fairness, the trustee will hire a financial expert along with legal counsel. The next step is for the seller to present an LOI to the trustee. The trustee, based on input by their advisors, will then negotiate with the sell-side advisor until terms are agreed upon. And once the terms are agreed upon, the transaction closes. So as I mentioned, this is very similar to a typical M&A deal.
That takes us into talking in a little bit more detail about how ESOPs can be structured. And one of the attractive things about an ESOP is that there's a pretty wide variety of ways that you can structure an ESOP. While you're certainly limited in terms of what the price is, there's a lot that you can do in terms of structure to meet unique needs of either sellers or of the companies. So there's kind of, while it's a wide spectrum, we've sort of picked two different kind of middle of the road examples. Call it a simple ESOP deal and a complex ESOP deal. And I'd mentioned earlier, even simpler than this, you can set up an ESOP as a new plan and simply contribute stock every year going forward. That's about as simple as it gets. More often, though, we see it set up with a transaction that really puts a bunch of stock into the ESOP that can be used to fund retirement benefits for the participants for several years. So on the simple end of those kinds of deals, you've got a relatively standardized structure, and you can get by with a minimum number of professionals. So Lindsay had described kind of the full team. Well, in this case, at the simpler end of things, you can get by with an attorney and a valuation advisor, pretty much as a bare bones team along with a trustee. That gives you lower transaction costs. Of course, there's less flexibility, but for some companies, that flexibility isn't necessary. And with that, of course, that lower flexibility, obviously, you may not be able to meet some of the unique needs of the business or the seller, but in many cases, it can work. On the complex side of things, there's a wide range of possibilities. And I think a useful way of thinking about this, in particular in terms of costs, a full-on ESOP deal really costs about the same as a fully marketed M&A transaction. So for instance, a fully marketed M&A transaction, you'd hire an investment banker, you'd pay a success fee, you'd have other transaction costs with the attorneys and other professionals. It's a similar level of costs to do a full-on complicated ESOP deal. The simple structures can save a little bit of money, but I think it's useful to go into it with the understanding that it's a similar level of costs as any other merger or acquisition deal. So a complex structure will have the full suite of professionals in order to be able to handle the nuances and details. And this kind of structure often includes some unique features in order to meet some specific needs of the company and the seller. So for instance, we'll often see a management incentive plan. This would be similar to what you might see in a private equity deal in order to align the incentives of management with the ESOP shareholders going forward. This is particularly useful in a 100% deal when management is no longer owners of the company, and it's useful to have an equity-based tool to align incentives. We'll also see seller notes with warrants. This would be like mezzanine debt. So in a 100% deal, it's a 100% leverage buyout. You can only borrow so much money from the bank. So often the seller steps in to fill the gap. And in that mezzanine position, it's usually appropriate to have warrants to get a market level of return. And finally, there's a lot of different features and levers that can be pulled to optimize for specific tax needs. And with those do come complexity. And that's why some of those features do require some more complexity and expense.
So now I'm going to walk you through a simple transaction structure example. For this example, let's say the transaction price is $10 million for the purchase of 100% of the company. And the transaction is going to be entirely financed with bank debt. So 100% leveraged ESOP transaction. In this example, the ESOP owes the selling shareholder $10 million. So how does the ESOP get that money? Well, in a simple transaction, it can happen in the following way. The company will borrow $10 million from the bank. The company will then loan that $10 million to the ESOP, and this is referred to as the internal loan. The ESOP will use the proceeds from the internal loan to pay the company. So now that the transaction has been financed, what happens going forward? How does this debt get repaid? The company is going to make retirement contributions to the ESOP. The ESOP will use these contributions to repay the internal loan to the company. At the same time as the internal loan is being repaid, shares are released into participant accounts. So the faster the company repays the internal loan, the faster shares are released. And now getting back to the bank loan. The bank loan, which was taken out by the company, is going to be repaid using operating cash flow generated by the company, which is how any company would repay any bank loan. And lastly, the participant shares are cashed out at the time of retirement or termination, and these are paid by the ESOP. So that's one simple example. And I think we want to take time here to pause and see if anyone has any questions, because following this, Nick is going to walk you through more complex examples. So we just want to make sure everyone is on the same page here. So please let us know if you have any questions.
I know one of the questions was about transaction costs, which I touched on a little bit. And at the danger of shooting from the hip, I'll kind of give a little bit of an estimate. For a simple transaction like this, where it's not the full team of advisors, you could probably expect on that $10 million deal transaction costs somewhere around $100,000. That would include professional trustee, valuation, attorney, as well as a TPA record record keeper administrator. Don't hold me to that, but that's probably a good data point and estimate for talking with your clients about a simple deal like that at that $10 million level. Let's give a little bit more of an example of what a complex ESOP might look like.
And Nick, it does look like we just had a question come through from Michael as well, relating to probably more of the simple example. Would it be typical for a certain portion of company profits to be used as the contributions to the ESOP?
Great question. So I think the easiest way of thinking about how contributions work and how a company might approach ESOP contributions, the ESOP is a retirement plan. So contributions to the ESOP should follow the company's philosophy on retirement benefits expense. What kind of retirement benefits expense does the company target? How does that fit into their overall compensation plan? So it's not so much that you would say put a certain portion of profits necessarily into the ESOP, unless of course the company had a philosophy of more of a profit sharing concept towards retirement benefits. Typically what we see a couple different ways that it's done. In some cases, a company might have a 401k that they're making a company match, and they might keep that 401k in place for employees to continue to do their own deferrals, but they would use the funds that had been used for the match and instead use it for the ESOP contribution. So employees, instead of getting a match for their 401k, they would be getting ESOP shares. In other cases, we've seen the ESOP actually be an add-on benefit. So understandably, a lot of management teams are reluctant to take anything away, and they may have a 401k with a company match, and the ESOP is nothing more than gravy on top of that. Some of the best scenarios we see are where companies really have not put together a robust retirement plan, and maybe they have a 401k, but they don't make any company matches or contributions, and the ESOP becomes truly a really valued retirement benefit. Looks like we've got another question here also. Another question about costs. So we talked about a little bit about transaction costs in the simple example. Question here is, what kind of cost do you have on a go-forward basis? And so at a minimum, on a go-forward basis, the ESOP is required to get an annual valuation, and you need a record keeper. So again, like a 401k where you've got your TPA or record keeper, you need to have a record keeper who does all the participant statements and calculations of shares and participant accounts. And in order for the participants to get a statement with their account balance, you need to know the share price. So that's where the valuation comes in. So those two expenses would be pretty much your kind of standard annual costs, and that together, along with a trustee, you're probably looking at $40,000 or so, give or take, going forward. And obviously there's cheaper and more expensive providers. Thanks for the question. Let's talk about a little bit more complex example. So building on what Lindsay discussed, take that $10 million deal, and let's say they borrow some of that money from the bank. And let's say the company makes a tax-deductible contribution, so pre-funds the ESOP. This is a way that the company can reduce their taxable income in the year before going ESOP. Then they lend the rest of the money to the ESOP. Now the ESOP has all of the borrowed funds and buys 100% of the stock from the sellers. Usually you can't borrow 100% of the value of the company, so the sellers need to make up the difference with a seller note. At this point, the ESOP has all the stock, plus an IOU to the company and an IOU to the sellers. And for a lot of reasons, it's a little messy for the ESOP to owe money to the sellers directly. So typically what we'll see is the company will pick up that note. The ESOP will assign the note to the company in exchange for a second internal loan. The ESOP might repackage that into a single internal loan with the company. And meanwhile, on the company side, the company will refinance that loan with the sellers and add warrants, for instance, in order to have a market level of return for the sellers for taking on that kind of mezzanine level of debt. Finally, the company might implement a management stock appreciation rights plan. Now, this usually is not a traditional stock option plan because we want to often, if the company is an S Corp, we want to avoid a second class of stock. But with an ESOP, usually it's something like a phantom stock plan or a stock appreciation rights plan, or SARS. And again, this is most common when a company does a 100% ESOP deal, just like a private equity sponsor wants to align management's incentives with the owners. Same thing with an ESOP. So this gives you a little bit of a flavor of some of the different features that can be used with an ESOP and some of the complexity that comes with those features. I'm going to hand it over to Lindsay to talk about what I think you're all here to hear about. I know we've got a group of CPAs here, so let's talk taxes.
Yes, so as we mentioned earlier, there are significant tax benefits related to an ESOP. Tax benefits to both the seller and the company. So right now we're going to focus on the tax benefits available to the seller. And the most significant is the ability to take advantage of Section 1042 capital gains tax deferral. Essentially, the selling shareholder is able to defer capital gains tax indefinitely if the following factors are true. The stock is C Corporation stock. The ESOP buys at least 30% of the stock. The selling shareholder has held the stock for at least 3 years prior to the transaction, and the proceeds from the sale are invested in qualified replacement property. Now, qualified replacement property is defined as debt or equity instruments of domestic operating businesses. It does not include mutual funds, government debt, real estate, and so on. If the selling shareholder holds on to this qualified replacement property until death, it is passed on to their heirs. And at this time, the value of the asset is equal to the value of the investment because the heirs have received a step up in basis. And therefore, no capital gains tax is due. Another tax benefit available to the seller is the fact that the sale of an ESOP involves selling the stock of the company rather than the assets. Now, in your experience working with clients that are going through a sale process, I'm guessing that you typically see buyers wanting an asset sale, which makes sense. An asset sale provides greater tax benefits to the buyer at the expense of the seller. So in an ESOP sale, it's the stock, not the assets, that are being sold, which is far more advantageous to the seller. The seller is able to avoid double taxation, and the after-tax proceeds of a stock sale are greater than the after-tax proceeds of an asset sale at the same headline price. Or another way to think of it would be that the after-tax proceeds of a stock sale are similar to the after-tax proceeds of an asset sale with a higher headline price. Another thing to consider is if warrants were involved in the structure of the transaction. Because if that's the case, the warrants provide the seller with some estate planning opportunities. Because following a leveraged ESOP transaction, the value of the warrants is fairly low. But just by paying down the transaction debt, that value is going to increase significantly over a relatively short period of time. So that gives the seller some nice estate planning opportunities there.
So you can see why business owners can get pretty excited about ESOPs. If they're willing to jump through the right hoops, it's an opportunity to indefinitely defer capital gains, as well as get more favorable stock sale treatment on the sale of their company. There's some benefits on the company side, though, too, which can be pretty interesting. And while the sellers don't directly benefit from it, the company benefits going forward. So in particular, there's really two big benefits. First, on a go-forward basis, because the ESOP contributions are a retirement benefit, a qualified retirement benefit contribution, that is tax deductible to the company up to 25% of qualified payroll, just like any other qualified benefit contribution. And when those contributions are made to a leveraged ESOP, remember the ESOP has a loan to the company, from the company that is. And so that cash comes right back to the company in the form of debt service. So the cash impact on the company of making that contribution is actually zero. Essentially, when you do a leveraged ESOP, you're pre-funding several years worth of retirement contributions in the form of stock. But you get the tax deduction even though there's no cash outlay. The net tax deduction is actually reduced a little bit by the fact that when that cash comes back into the company, a portion of it is non-taxable debt repayment, principal payment, and a portion of it is taxable interest. So the net deduction, let's just walk through an example. Let's say they make a $200,000 annual contribution, and let's say $50,000 of that is interest. The other $150,000 is principal, so they've got a $200,000 deduction, net of a $50,000 interest income for a $150,000 tax deduction and zero cash outlay to meet their annual benefits. So it's a pretty slick deal when you look at it from a tax efficient way of meeting a benefits obligation. And if we step ahead, we get to the holy grail of ESOPs, which is if the ESOP is, if the company is 100% ESOP owned S corporation. Of course, an S corporation is a tax-through entity, and an ESOP is a tax-exempt entity. That tax obligation flows through to the tax-exempt entity, and the buck stops there. So it becomes a tax-free company and pays no federal income tax and no, in many cases, no state income tax. And I'm scanning the questions here, and I know somebody caught my typo. I know. I said I typed in $150,000 of interest expense instead of 50, but I knew I couldn't slide that by some eagle-eyed CPAs. So thank you. So you can imagine the advantages to a company on a go-forward basis if it doesn't have to pay federal income tax or state income tax. And that can be a pretty attractive option. Again, on the company side, the sellers don't get to benefit from that. I'm going to hand it over, actually, yeah, we got some questions here. So let's take a look at some of these questions. Liz, can you help us pick out a couple questions to answer here? I think we've got plenty of time to do it, and I appreciate you guys jumping in with questions.
That sounds great. Nick, while we do the questions, let's launch our third polling question, and then we'll dive into the audience questions. The first one I can answer very quickly. Tom is wondering if a recording will be available. And yes, there will be a recording of today's program available. You'll be able to download that from your Incorsa dashboard later this afternoon. So again, that third polling question is open up on your screen. And yes, Nick, we have some good questions. So let's take the question first from Nick. He's asking about S Corp conversions. What happens if a company does an S Corp conversion prior to executing an ESOP? How does that impact the capital gains benefit?
Good question. Yeah, there's a lot of tax nuances that come up with an ESOP. So if the company is an S Corp prior to doing the ESOP and it does not have the ability to convert back to a C Corp, then the 1042 deferral on capital gains is not available to the selling shareholders. So that's an important thing to understand, that 1042 capital gains deferral is not available in all cases. It's only if the company is a C Corp or if there's a way to convert it to a C Corp before the sale.
Great.
I think I'll add to that, what we do often see with S Corps is prior to a sale, usually the company will make a distribution of the AAA account and zero that out and distribute all the tax-free cash that's available to distribute before they do the ESOP transaction.
Very good. Thanks for adding that on. We have another question from Brian, and Brian is wondering about the current management team. So if the current management team or the company is the potential buyer, what are the pros and cons to them in an ESOP as compared to an asset sale?
This is a good question. It really highlights kind of the difference between an ESOP and a management buyout. So in some sense, an ESOP is an alternative to a management buyout, and in fact, it may be almost a competitive buyer to management. So if management really wants to own the company among a small group of people, an ESOP may not be the best fit because the ESOP is a broad-based retirement plan. And it gets a little bit messy if you have a small group of shareholders owning a chunk of stock along with the ESOP owning the rest of the stock. That may be a situation where it's better off just to do a management buyout. It's not out of the question that management could own the company alongside the ESOP. You just need to be careful about managing conflicts of interest when you're a controlling shareholder as well as looking out for the needs of your employees in the ESOP.
Very good, thank you. And while we were answering those questions, that third polling question was out there, and we used that polling question to segue us into the next section of the presentation. So we were kind of testing your knowledge in advance, and I'm going to go ahead and close that polling question and share the results. And it does look like 74% of the audience got this question right. And Nick and Lindsay will be able to talk a little bit more about the details about why all of the above is the right answer in this next section.
Fantastic. Well, thanks, Liz. And certainly some of those companies might be better fits than others. And I realize there's a risk. We love ESOPs, so there's a risk of sounding like ESOP cheerleaders. I want to make sure that, that you guys help your clients explore ESOPs eyes wide open and understand that it's not necessarily a silver bullet. So there are certainly some caveats. An ESOP is not for everyone, just like we talked about with that management buyout example. That the ESOP may not be the tool to do that. ESOPs do invite regulatory scrutiny and potential litigation. Think about all of your business owner clients. Chances are a lot of them are rugged individualist entrepreneurs who probably are not real crazy about inviting the federal government into their business. So they need to be comfortable that they are inviting some more regulatory scrutiny into their business. And there's additional compliance. There's professional services. We talked about the professionals that help make an ESOP deal happen, as well as on an ongoing basis. And those entrepreneurs, if they're going to remain involved in the business, will have to get used to answering to other people, and they'll have to get used to the fact that they no longer own the company. There's complexity, and there is kind of an element of sort of the victim of your own success in that ultimately you're building up value in this retirement plan, and the company is the vehicle to cash out that value for the employees. And so it's important, particularly for the CFO and the management team, to make sure that that repurchase obligation is managed properly. And by that, of course, it doesn't mean you would want to hold back the value for the employees, but instead make sure that that the company plans its cash flow and liquidity needs in order to be able to meet that obligation and meet that promise made to the employees. Finally, and this is in bold, I want to be very clear that taxes should never be the driving factor. In our experience working with possibly hundreds of ESOP companies, the ones that go well are the ones that are done for a lot of reasons we'll talk about in the next few slides, and the taxes really become gravy. An ESOP deal is not the highest price that you can get for a company. The sellers have to be comfortable that they're leaving money on the table. The tax benefits can kind of soften the blow a little bit. They can make up for that, but they should never be the driver. The ESOPs that we've seen go poorly are the ones where the business owner says to us, "I'm sick of paying taxes, so I want to do an ESOP." That's usually a situation where you want to run away from an ESOP and help them find a different solution. So I'm going to hand it over to Lindsay to tell you a little bit about some of the qualities and characteristics to look for in companies that may be a good fit for an ESOP.
So how to identify good ESOP candidates. There are financial, cultural, and selling shareholder characteristics that you can look out for that will help you identify which of your clients might be a good candidate for an ESOP. So we're going to start with the financial qualities. With an ESOP, you're making your employees shareholders. And in doing so, you don't want to give your employees ownership of a volatile stock. And for this reason, consistent cash flows and reasonable visibility into future performance is helpful because these factors will help reduce the risk of major swings in the stock price. Like any stock, the price is going to change, it's going to fluctuate, go up and down, but we really want to reduce those big swings. These next two bullet points really get to the size of the company. And there's technically no minimum size in terms of equity value or number of employees that a company needs to be a successful ESOP. But there are some sizes at which the benefits of an ESOP are outweighed by the costs required to implement and maintain the ESOP. I know Nick spent some time earlier discussing the cost of implementing an ESOP and maintaining an ESOP. And those costs really need to be taken into consideration, especially if this is a smaller company. So we would recommend equity value of at least $3 million, and it would be ideal if equity value was above $10 million. And in terms of the workforce, a minimum of 25 employees And ideally, a workforce of above 50 employees would make for the best candidate for an ESOP. Lastly, under the financial qualities, we've listed borrowing capacity. So if your client's considering a leveraged ESOP transaction, it's beneficial if they've got some assets that they can borrow against on their balance sheet. So now we're going to transition. We're going to take a look at some of the cultural qualities that make for successful ESOP companies. And really, in order for an ESOP to become a true competitive advantage for any company, these cultural characteristics are key. And the first of which is an experienced management team. We mentioned before that throughout an ESOP transaction process, the management team is typically able to remain intact. And because of that, already having an experienced management team in place is a huge advantage. They will help guide the company through the transaction and ensure a smooth transition following the transaction. A strong positive culture is very beneficial along with educated or inquisitive employees. ESOPs are complex. They're not intuitive. It takes a lot of communication between management and the employees to understand what benefits these workers are actually receiving. So if the staff of one of your clients is highly receptive to learning more and really digging in, then the transition to ESOP ownership is going to be a lot easier, much more well received. So that's really a key factor when we're looking at a company culturally. How open are their employees to learning more? Another factor would be a high level of trust between employees and the owners, along with a high level of trust between employees and the management team. And this really goes hand in hand with what we were just talking about, but ESOPs require a lot of communication. A lot goes into conveying the benefits that an ESOP can give to employees. And so if that trust is already established, the communication is just going to go over much more easily. Also, low employee turnover and a long-term perspective. And this long-term perspective needs to be something that's maintained by the employees and the company. Because as we know, stock prices can fluctuate, but an ESOP is really in it for the long term. So it's important to have that long-term perspective.
Yeah, I think you could kind of think of it in a nutshell. Good companies make for good ESOPs, and a good ESOP does not paper over a bad company. Let's talk about owner characteristics. So Lindsay gave you a little bit of a flavor of what might be a good fit from a company standpoint, but it really comes down to the owner. What does the owner want to accomplish? What's important to the owner? What are their values? And where we see ESOPs particularly resonate is with owners who have a lower priority on maximizing value and a higher priority on qualitative things, in particular legacy. So that may be a family business where they want to preserve the legacy of the company name, its role in the community. It may be a rural business. We see, in particular, we go into northern Michigan, there's a lot of companies in some of these areas that are there because that's where the people are, that's where they want to be. Any other buyer might move it to a different part of the country or to Mexico, and an ESOP is a way to ensure that that doesn't happen. We see a lot of owners who take maybe a little bit of a paternalistic or benevolent dictator kind of view towards their employees and want to look out for them. And an ESOP tends to resonate with people who have that point of view. And like I said, an ESOP is not for someone who wants to squeeze every last dollar out of the company. There's better ways to do that. Selling to a strategic buyer, hiring an investment banker, that's the way to do that. It also can be a fit for somebody who wants to maintain an active role in the company. An ESOP is an ownership succession tool. It's not a leadership succession tool. So an ESOP can be done independent of the ownership of the management succession, as long as the owner understands that now he or she is working for the ESOP and they're not working for themselves anymore. Likewise, under the same circumstances, it can be a way of taking some chips off the table when they're not ready to fully exit. So with that, I think that covers really our prepared material. We've got some more good questions here, and I really appreciate the input and the interaction. I want to touch on some more of the tax questions, in particular C Corp versus S Corp. And then I may have Liz help us identify some of the other questions here because I can't talk and read at the same time. But there's a few more follow-up questions on S Corps versus C Corps, what's better, and the limitations. And there's really no one right answer, and this is why we see so many different types of ESOP transaction structures. It depends on the specific tax situation of the company and the selling shareholders. Certainly, I'll give you an example. We've got an ESOP client that had converted to an S Corp within 5 years of doing the ESOP deal. So they were not able to convert back to a C Corp. And so as a result, they weren't able to take the 1042. But it wasn't that important to them because they wanted the liquidity and they didn't want to have to jump through the hoops of doing of the qualified replacement property and so on. We've got another ESOP client, a little bit of the opposite situation. They have a large NOL and they don't want to convert back to an S Corp. And I think they have some limitations in their ability to convert back to an S Corp for a couple years yet. We did a 100% ESOP deal. They're not able to take advantage of being 100% ESOP S Corp for a few years. And in the meantime, they're able to take advantage of burning through the NOL as well as some of the additional deductions on the ESOP contributions. So it really is a facts and circumstances kind of question. Again, you guys, as the tax experts, can help your clients understand that side of it, particularly with the non-ESOP aspects of the tax situation. Seeing a few more questions here. Liz, can you help us identify a couple that we should address?
Absolutely. So we have another question from Nicholas, and wondering just about generally, is there a free cash flow type requirement that a company owner or a CPA advisor might think about? We talked about equity value, we talked about number of employees. How would you look at maybe a free cash flow requirement?
I like that question. I think it really speaks to, as Lindsay had mentioned, volatility more than anything else, because it depends on how the deal is structured. If you're going to do a 100% leverage buyout, you do need some consistency and visibility in those cash flows, or you need a flexible financing arrangement. That's where we often see seller financing used to provide some flexibility. It's that kind of friendly capital where if there is a dip, they're a little bit easier to work with than maybe a bank. In terms of kind of a threshold for free cash flow, I might kind of translate it into value. So if we've got $400,000 of free cash flow and maybe call it a 5 times multiple, that's still on the low side of equity value. But it's probably, that's probably the point at which you might be able to start thinking about an ESOP, particularly if that cash flow is pretty stable. If that's a company with only 10 employees, it may not be the way to go, because all it takes is 1 or 2 people to retire, and you can have a disproportionate impact on the company's cash flow.
That's really helpful. Thanks, Nick. And we have a couple other questions too. So here are 2 separate questions, but it might be kind of interesting to think about them together. So one is, can you comment on the seller's remorse as relates to an ESOP? But then also a separate question is, how, again, is an ESOP different than a normal acquisition? And maybe those kind of look at the logistical side and a little bit of the emotional side as sellers getting ready to think about succession planning.
Well, I'll take the seller's remorse, and I'll let Lindsay ponder the differences between a regular acquisition, and I may chime in too because I can't help myself. But
sounds good.
With the seller's remorse, the times when I've seen it are when the ESOP was not done well and not for the right reasons. I can think of one transaction where we came in after the fact, The ESOP was done maybe under some optimistic assumptions, and the assumptions didn't play out. So the cash flow wasn't there to really support the ESOP after the deal. And in fact, the Department of Labor took a hard look at the deal and said, you overpaid. And the selling shareholder, who was still the chairman of the company, had to give, had to give some of the money back. And in that case, it was in the form of, he didn't have to write a check, but it was in the form of reducing his note receivable from the company, his seller note. So that was certainly a disappointing situation for that seller. It was a company that maybe was too small to be an ESOP. They had huge customer concentration. He might not have gone into it entirely eyes wide open and presented far too optimistic of a picture to the trustee buyer and the trustee's valuation advisor. So that would be one example where we've seen some seller remorse. I think other situations where we've seen some disappointment would be where the owner kind of forces the ESOP onto the company, onto management. It's something they want to do, but then they ride off into the sunset, and management's left kind of holding the bag, and they were never on board with the ESOP. It wasn't their idea, and they don't quite know what to do with it. So that's why it's important, to Lindsay's point, that you've got a solid management succession plan, and that management is really on board and bought into the ESOP.
And in addressing the question of the major differences between selling to an ESOP versus a typical M&A transaction, there are a couple major factors that I think would be good to discuss here. And the first of which is selling to an ESOP typically grants the existing management team far more freedom than if the company were sold to a private equity firm or to a strategic buyer. The company can really continue to operate under its own agenda, its own goals, its own strategic vision, rather than, say, the strategic vision of a private equity firm or some other buyer. So there's a little bit more freedom there. And the employees become owners. So ideally, in the sale to an ESOP, just the culture surrounding the company becomes a lot stronger. Although I will note that just allowing the employees ownership does not always guarantee that they will act like owners, because that's certainly not always the case. And from a financial point of view, we spent some time going over the tax benefits, but selling to an ESOP provides far greater tax benefits for the company and the selling shareholder than a typical M&A sale would allow for.
From a transaction standpoint, the ESOP deals do tend to close a little bit quicker, and you've got certainty of close, provided the seller can accept fair market value. You don't have the question of whether or not you've got a willing buyer, because you've got a willing buyer at fair market value. So there is something attractive about that certainty of close.
Awesome. Thanks so much for taking time to answer questions. I think we're getting pretty close to the top of the hour here. And Nick, I know before we go into that final polling question, you wanted to just share a little bit with the audience about how they can get in contact with you if they have any future questions.
Absolutely. So you've got our contact information in the presentation. I think Liz is making this presentation available to everyone. We'll take a look if there's any questions that we've missed along the way. We'll address those with the audience in a follow-up email. But we're happy to make ourselves available for a one-on-one conversation with any of you. Please contact us. We're happy to do that, have a half-hour call off the clock, and answer more specific questions. If we walk through a scenario, maybe you've got a client that you'd like to talk with about an ESOP, and you want to bounce some ideas off of us, we're more than happy to do that.
Thanks so much, Nick. And like you said, your contact information is available in this presentation, and the audience will also receive a follow-up email with your contact information as well to make it really easy. So we do have that fourth polling question coming up. We'll go ahead and launch that, make sure that everyone who's joined us today has a chance to respond. And the question is, would you like to learn more about ESOPs? And is this something that perhaps you might be interested in talking with Nick or Lindsay or a member of the Adamy team sometime this month, possibly before the end of the year if you have some clients in mind. I know Nick and Lindsay are very willing. They love brainstorming and strategizing. So if you say, hey, I have a couple more questions, might want to just talk that through before I present it to my client, Nick and Lindsay are fantastic resources for you to do that. So you can get in touch, and thanks for taking some time to join us today. We'll leave this polling question open for just another 5 seconds or so, and then we'll head into our close. So thank you very much. We do have a quick question that's coming in while this last polling question is open here at the top of the hour. The question is, someone is actually looking at this for their own exit strategy, and they would love to chat with you. So we'll make sure to get their contact information over to you at the Adamy offices and let you get in touch. So I'm going to close this poll down, and just a brief moment on behalf of Incorsa, we want to thank you for joining us today. We want to thank Nick and Lindsay for an excellent webinar. Be sure to check out our upcoming programs. I know as we head into the final segment of the year, CPE is on people's minds, so Incorsa has a great lineup of programs. Definitely hope to bring the Adamy team back to join us. As you close the GoToWebinar browser, you can take a short survey, and then you can log into your Incorsa user account to access your CPE certificate after an hour has passed. You'll also have access to the recording and to the course materials. So I'd like to say thank you again to Nick and to Lindsay for joining us today, and thanks everyone, and we hope that you have a wonderful rest of your day.